There you go.
Oh, I'm looking around. I'm sorry, people. It's 1 o'clock on the East Coast. We're in Florida. You'll notice I'm wearing.
What are you wearing?
My CME golf shirt.
Oh, yeah, it's pretty dope.
So it is 1 p.m., 15th of November. We were supposed to play golf today. You, me, Danny Moses with Celine Boutier.
Yeah.
Did I say that right, Danny?
Yeah.
Danny's here, by the way, but he's working on a few
He's
things.
so bummed that we're not golfing. So we're down here for the CME
Well,
Cup.
we would have won.
We would have won. We were like the #1 ranked in the CME, and Celine Boutier from France, and she's actually playing for the French in the Olympics this summer in Paris.
And we kind of cool. We were paired with her last night at a pairing event that Dominic Chu of CNBC hosted, and we were all fired up. We were all ready to go. I had my golf shoes on.
Rained out. You got your golf shirt still on. Yeah. Pretty cool.
Well,
all right. So we're here. Yeah. So we got stuff to talk about. Let's go to the rundown
because that's what we do.
That's what we do. We got
safety
a lot of stuff
trades.
Yeah.
Laggards to leaders.
Yeah.
That'd be a good name of a band. I saw something. I was watching.
Punk rock band or no?
No, I was watching that Pawn Stars.
Yeah.
And you like that band, the Beastie Boys?
And they're just Beastie Boys. It's like Eagles, like Eagles.
No, no. They're not anything like Eagles. Okay, let's
fair enough. 4 and 3 and 2 and 1. When I'm on the mic,
Cisco, Palo Alto, all report earnings. So here we are.
Yeah.
Another. Now, yesterday obviously caught me off guard in terms of the reaction. The bond market continues to sort of, again, the volatility is back today. Yields are up about 10 basis points in 10-year. Market doesn't seem to care.
Kind of weird. So if you think about this, the 10-year guy, you know where it was the day before that CPI report? Yeah, it was like 455. You know where it is today right now?
455-ish. I'm rounding.
So what happened?
Nothing. But the market seemed to like it.
Yeah.
And I actually read about the CPI number, which,
you did.
As you said yesterday, was a little bit softer than expected. Somehow embedded in this number was a 35% year-over-year reduction in healthcare insurance. I saw this. So you know what I did? Because I'm a smart guy. I called my healthcare insurance provider and said, hey, I see that the costs are down 35% year over year.
Yeah.
I'm not seeing it in my bill.
Yeah.
They hung up the phone.
So what are you saying? It's a bit of a fugazi?
That's exactly what I'm saying.
Okay.
Now, look, I'm not a conspiracy theorist person. I don't give a shit, but I'll say this. There's no way that now maybe it's measured somehow that I don't understand. That's clearly possible. But there's something going on here. But the market championed that yesterday, and here we are today, and the market's up marginally today. The S&P's, I think, up 11 handles or so, but rates are back to your levels, as you mentioned.
Yep.
There will be more treasury auctions, which will not go well. And I sit here, people say, oh, you can't accept defeat. No, it's not that at all. I'm not really certain what the euphoria was yesterday, but here we are today. Dan.
Well, all right. So let's just take a look here. So the last time the S&P 500 was at 45.20, or so. Okay, we had yields that were kind of in the same spot. And when you think about that, the dollar is a bit lower than where it was before. Crude oil is a bit lower than where it is for those two things. I think are all probably pretty decent for equities if you consider. But why are equities rallying it with the ferocity that they are right now when the data is coming in weaker, right? So, that's the thing is like, if you just kind of take a step back and you say to yourself, and this kind of has to bring back to the stock market too, and think about expectations for S&P 500 earnings, they're basically too high for next year, right? And so with a weakening economy, when you have unemployment rate ticking up, despite the fact that inflation readings are ticking down, if there's any reason for them to go back up, I think it was Jamie Dimon was quickly out last night just saying, listen, like not so fast here, I don't know. Listen, it goes back to the target for the Fed is 2% in inflation. We have a 3.2% CPI, ex food and energy, it's 4%. I know that this PPI came in more than people expected, but I just think the ingredients for why the stock market rallied to the extreme that it did doesn't make a lot of sense. So, you could say,
well, so part of it, I think, is the market getting ahead of this notion that there are going to be cuts. And Danny mentioned this yesterday.
Yeah, I did.
A lot earlier next year than people probably think. Maybe that's true. So if your play is Fed cuts, stock market goes higher, it's just that simple. Okay, as you would say, have at it, people.
Yeah.
You mentioned inflation. Yeah, and I know, I'm not trying to be nuanced. I'm not trying to be, semantic thing here, but inflation isn't going lower. It's just going up slower. It's just increasing at a slower rate. I mean, inflation is still increasing. So it's just increasing at a slower rate. It's not helping anybody out there. I mean, for most people, well, for everybody out there, inflation's up some 20-something% cumulatively over the last couple of years. Let's keep that in mind as well. But to your point, the unemployment rate will continue to tick higher. The economy will continue to slow. And at a certain point, that has impact on earnings. And earnings expectations for next year are still way too high. Again, people say sour grapes. It's not sour grapes. I mean, that's just the math of the entire situation. But I think there's this belief system still in place that as long as the Fed is going to be accommodative early next year, why am I going to wait? Let's get ahead of it now. And I think that's what we're seeing. At least that's what we saw yesterday and to a certain extent today.
Well, I started the week off with Liz Young on the tape podcast. I just said the higher that we go, okay. And Liz actually laid out on Monday morning on the pod why she thought that equities could continue to rally, and again with a benign CPI report. And I wasn't something that I wanted to fight right there and then before the data either. But the higher we go into year end, I think is the harder we fall. And, there was some stuff going around on the web over the weekend or so talking about, all those bears, who are predicting, the S&P, which had come off, I think at its lows a couple weeks ago, 10% from its highs. It was up maybe mid to high single digits on the year. And I think I said on Fast Money, I think there's a really good chance that we give all of that back. Okay. And maybe close flat-ish. And I was looking at the Russell 2000. I was looking at the equal weight S&P 500. I was looking at a whole host of other things. The economy weakening and just saying, well, why should we be up on the year? And so when you think about where we are right now, the S&P is up 17.5%, the NASDAQ is up 34%, and the NASDAQ 100 is up 44%. That's not happening. Okay. So we are not closing down in the S&P on the year right now. Let's just be really clear. It would have to take some really horrible thing to happen that none of us want to have happen. All right. So if we've only had 4 times since the Great Depression, Guy, where the S&P has closed down consecutive 2 years in a row, it kind of makes the case that maybe next year is a much harder year. If earnings expectations are very high for the S&P 500, valuations remain high, the economy is slowing. And then if you think about just the wall of worry, I know that's not a term that you like to use, that we are climbing right now. If we have inflation that's sticky, if we have higher rates for longer, if we have stagnant sort of growth, if we have geopolitical hotspots all over the place, to me, I think it sets the stage for maybe a very tough slog for equities next year. So again, just to put a little bow on that, the higher we go right now into year end is the harder that we could fall early next year.
And we should look at the S&P chart for illustration. So we know this. We traded down through the moving average in a pretty violent way. It felt like things were going to continue to break down. That was obviously thwarted. And then we've seen the moves subsequently since. And now we're back through. And now here we are creating some gaps to the upside and the potential to push to levels that I guess we saw, Dan? I'm just trying to go back in August-ish or late July, right? So there you are.
Just, I quoted the S&P. I was quoting the futures at 45.20. So the cash is basically just around 4,500 or so. And again, that was the level that we kind of, those July highs, we came in pretty hard. We had a big rally in August. And then that kind of 45.20 in the cash was kind of that breakdown level. But think about this. We've gone from 41.90 to 4,500 in literally a straight line. That 200
a straight line with a couple of gaps along the way. Yeah. And Carter would point this out, and we'll have him back, I'm sure, tomorrow. So, and we'll hash it out. But when people talk about it looks great on the way up, but these gaps that are created, as Carter will tell you, typically do get filled. And the violence with which we've gone higher, whatever this is, year-end chase, slow markets, holiday shortened weeks that we're going to start to have. You say it all the time, have at it, people. Now, people say, well, all right, we're starting to see incrementally better things. The Target report, for example, we can look at a Target chart real quick. Target chart looks good. I mean, and they've been pushing that thing down. We were within... we kept pushing down to multi-year lows. You got an inventory that, down 14%, I think, year over year, which the market champion. They beat on EPS. The fourth quarter guide wasn't anything special. I think the fourth quarter guide gets you to the midpoint of what street consensus is, about $2.25 or so. But when the market is looking at margin improvement, they seem to be through their inventory problems, and people say, on valuation, I can wrap my head around this, and maybe the worst is over. And maybe the worst is over for Target. I don't know. I don't think necessarily that's the case, but again, people will look to that as one more incremental reason to be bullish for the overall market.
Yeah, I mean, listen, for a stock that's been cut in half over the last year and a half, and you have an 18% rally, you can do the math. It's still well below those prior highs, especially when one of its major competitors, Walmart, makes new highs every day over the last month. And we're going to look at Walmart. They report after the close tonight. We'll look at that in a little bit. But again, listen, we say this all the time, like if you're a trader, the idea of pressing a stock like Target where sentiment's really bad, the stock can't get out of its own way. It acts really poorly to some of its major competitors, to the broad market, that sort of thing. Not a good press. It's just not. I'm not saying you have to get in there and buy it. I wasn't suggesting that, but we were talking about it on Fast Money over the last few days in the lead up to it, like a short Walmart, long Target spread makes a lot of sense, both on valuation, both on sentiment, both on a whole host of different things. And so again, a lot of you guys are not set up to trade like that, but that's the way, if you're trading in a long short equity fund and you are sector focused, those are the sorts of kind of trades that you put on.
I agree with that, but I agreed with the sentiment of it, but I was one of the people that said, I understand what people are saying. People have been saying that for quite some time now, that, in terms of the ratio between the two, it's time to sell Walmart and buy Target. I was not in that camp. Turned out this was the correct quarter to do it. And we'll see how long that relationship lasts. I mean, as you said, we'll talk about Walmart. At least Target now with this quarter, you can wrap your head around the stock in terms of valuation. Walmart is by all metrics and historically speaking, it's getting a little expensive. So they better say some pretty good things in order for the stock to continue to make new all-time highs, or maybe we're going to start to see that gap close. But I want to be clear, I thought the relative weakness of Target and the relative strength of Walmart could continue.
Right. Okay. Let's look at a couple sectors that took it on the chin as yields went up to that 5% in the 10-year. Okay. So let's start with consumer staples. And it was very noticeable just the way that a lot of those stocks, Coke, Pepsi, Procter, Johnson & Johnson, were kind of careening lower. This was in September. The XLP, the ETF that tracks the staples, had this really nice rally after that cascading sort of low that it had here. It got right back to that kind of resistance level guy in the XLP. And again, we've been talking about some of the names in the sector, their ability to kind of pass through increased costs to consumers was getting a bit more constrained, right? So that was one of the reasons why those stocks that paid good dividends, deemed to be, defensive, were trading well in different periods of this year, right? When I guess there was, kind of negative sentiment into the broad market, but rates went up, they went down. Here we are now with the XLP in and around the $70 level. What do you think on these?
Nothing's changed, though. I mean, their ability to pass on. I mean, they hit that point of diminishing marginal returns in terms of what they could pass on to the consumer, and obviously, you saw that precipitous drop. We talked about it over the summer. I think the bounce is exactly that, a bounce, and people saying,
you fade it. So you think rates are going higher? You think we're going back towards 5%?
I do think. Now, listen, there are people that are like, there's no way, given the weakness, I don't want to say strength of the economy, the relative weakness of the economy, that rates should go higher. And I understand that argument. I think the flip side of that coin is, and this is something that Danny has talked about as well, I mean, there are going to be more treasury auctions that are not going to go particularly well, and the market's just going to demand a higher yield to buy our debt. And you go back to the Moody's. The note that Moody's put out on Friday, only the stock market has changed. The underlying nonsense that they cited hasn't changed. And again, whatever continuing resolution, that doesn't help the cause. We have not gotten our fiscal house in order by any stretch of the imagination. And by definition, the market's just going to demand a higher and higher rate of return to buy our debt, because the incremental buyer that had been there for decades, they might be there, but that they're at a much higher level.
Yeah. And so the same thing for utilities, they had this bounce. So again, I'd probably, if you're in the camp that rates kind of stuck here at 4.5 or maybe go higher, and you were, kind of bottom fishing in some of those defensive sectors, I'd take them off here just from a technical standpoint. They're still in downtrends. They got back to those resistance levels. The other one, and this is one that I know that Danny's been talking about with us on the tape. Let's look at home builders for a second. So let's look at the XHB and just look at this kind of precipitous drop.
Yield chart. I mean, that's an inverse. If you think about what that is, I mean, again, it's very similar in terms of what we saw with some of these staples that sold off. We talked about home builders as well, and I will be clear that we were actually pretty constructive on home builders most of the end of last year into the summer of this year. And one of the things that we were saying pretty consistently is, and I didn't know what the level was, but I thought once yields hit a certain way up in 10-year, that was going to be this line of demarcation where everything, I think it wound up being around 4.5%-ish over the summer when everything sort of went, not pear-shaped, but that whole relationship changed. And obviously, as we push towards 5% in the 10-year, home builders came off in a pretty marked way. Now, they're bouncing now on the back of yields going lower. But the question you have to ask yourself, other than that bounce, what has changed? Nothing at all. So I think, and again, just my opinion, if I'm of the belief that yields are going higher, which I just stated, I don't think there's any compelling reason to continue to own the XHB specifically here. Again, that's just my opinion. Other people say, wait a second, you're off sides here. The supply-demand imbalances exist. And if rates are going to go down, then you want to get on board with these home builders. And I say it all the time, that's what makes markets.
Well, I'll just say this. I mean, if rates now are down because the economy is weakening and unemployment's ticking up, and I know there's been a lot of mortgage activity with yields coming in, the way they have over the last, let's call it, few weeks or so, it really, I mean, that might just be a knee-jerk reaction. I look at the XHB and I just say, okay, so it sold off nearly 20% from its highs over the summer to its recent lows. Now it's bounced 17% or so. I'm looking at the options, and maybe Amanda can pull this up on the fly. Implied volatility, the price of options, and the XHB over the last year. You can just see how it's come in fairly dramatically, from above 35% in the IV to below or ish around 25 or so. And so if you want to make a directional sort of bet in the XHB, I might look out to when do you think a rate move, Guy? When do you think we could get back to 5% in the 10
Well,
year?
I should know when the next major auction
Fed meeting is
no, forget about
13.
Fed. Forget about those assholes.
Okay,
I'm not interested. I mean, I'm just saying.
I got you.
Now it's just about Treasury auctions and what and how the market reacts to that. So I don't have it in front of me, unfortunately. Whilst I was donning my golf wear, I didn't look it up. But there will be more auctions, and they're not going to go. They're just not going to go well. Yeah. And the last one that we saw that was a disaster. I mean, you saw a market move in yields. I think yields spiked almost 14 basis points, and that coincided with the stock market that sold off pretty dramatically. That wasn't the first time it happened, and I'm here to tell you it won't be the last time it happened as well. So, again, in a market that's demanding a higher yield to buy our debt, which they should, by the way. I mean, the rating agencies are telling you that. Yeah. Yields should go higher.
So here's something. So with IV and the XHB coming in this hard, and if we want to pull up then the chart, and if you look at just kind of like where you think, so the 82 put, okay, that's the at the money put, Guy, all right? The ETF is trading at $82 right now. In January expiration, you could pay about $3 for that, all right? So that's about 3.5% of the underlying price of the ETF, right? Maybe I want to turn that into a put spread. I want to look at the 82.72 put spread. That would cost me $2.50 because I'd sell one of the 72 puts at about 50 cents or so. And if I'm just looking at that on the graph, do you call it a graph or do you call it a chart?
I'm looking at it too, and I'm looking at it with you. I call it a chart. Yeah. Some people call it a graph.
But like if over the next 2 months, if we were to have yields go back to 5%, why shouldn't this go back to last month, the October low near $70? So you could have the $10 wide for $2.50, and if you have this thing back at 72 or lower.
All right, so here you go. So here's my question to you. Yeah. Are you getting paid enough on that lower end?
Yeah.
Okay, that's
you know what? I mean, like, listen, you know what? Like, the truth is like it's so far out of the money. You're just trying to take a little off there. You know what I mean? You're
take the edge off.
Yeah, a little bit.
You're trying to
sort of listen. The other way to trade
like
this,
a coupon.
No,
like you buy the. So what you're asking me for full price, and then you give the coupon.
You're asking me why not leg into it? Why not pay $3 for that Jan 70 or 82 put?
That's exactly what I'm saying.
Okay, so that your break even would be down at 79. Let's say it quickly goes to like $80 or 79.5,
because then those 72 puts that you sold for 50 cents theoretically
they're going to be worth they're not going to move that much if the stock or the ETF moves down there. And I want to tell you, maybe you guys can all this is a little like the more
this
you
is
know
inside
here.
Baseball.
So here I just want to say this. So the 72 put right now has it's got about like a 10% probability of being in the money on January expiration. That's what the options market is saying. So for every dollar that the XHB moves in that direction
to the downside,
okay, that put should increase by 10 cents. Okay. So at $79, that put that you would sell maybe for 50 cents or something like that. Yeah. You add,
75 cents. Understood. Fair enough. No, but yes, all true. And we should get off this, but vol will start to work in your favor as well. So you're going to get that vol kicker as well. But again,
optionality is your point. Sometimes you just leg into something and then you basically could roll that put down if you got it going in the right direction, or you could spread it. But I'm with you. I just thought that was a kind of an interesting setup.
I listen, agreed with you.
So
100%.
Going back, all right, let's move it along here because I know we got to get out of here soon. Let's look at the NASDAQ 100 because this is obviously
the
money
most interesting chart
poured into the
most interesting
stock market.
Man in the world. Danny Moses is the most interesting man in the world.
Well, less so today. He's just over there.
You know why he's in a bad?
He wanted to golf today.
That's what he wanted to do. But I'll tell. Listen again. 2 years ago, he won the Pro-Am.
Yeah, he did.
Danny Moses. He emerged victorious. Last year, I think there was some sort of accounting irregularities, and he wound up being third. And I know that he was upset about this because I think last year he felt as if his team probably acquitted themselves better than the year that they won.
Yeah.
This year, coupled with me, who probably wasn't going to pull a club out of my bag, and some guy that we've never met before,
Ned
but
Campbell.
it didn't necessarily. Who?
Ned Campbell.
Ned's watching the shine.
Shout out. Ned.
But we were coupled with basically the best player in the world. So as long as Danny's game was okay, it didn't matter what we did. She was going to carry us along with Danny, and we would have stood at the podium this evening at the awards ceremony and gotten another, emerged victorious again. His name would have been etched in some sort of, what do they put him on, like a bell or something? Or,
maybe a bell.
And when you go out there, you're all geared up. He was on the driving range, as were you, hitting some balls. All of a sudden, it starts to drizzle. Ball. Then they say, okay, we're going to push it back, 9:15, 9:30, 10, 10:30, blah, 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 canceled. And that's...
You know what? I did a little Instagram story. You guys should go to our Instagram. Guy and I both have Instagram. Risk Reversal Media has an Instagram
so he's
page.
Upset.
I'm Dan S. Nathan. You're Guy.Adami. I did a little story from this morning. Guy, I want to go back to the QQQ.
But just to sort of put a bow on this.
Really?
We will get him out of his funk later. Like there's more stuff happening. What's her name?
It's an open bar.
Sunday Night Football. The one I can't wait for Sunday night. What's her name?
I don't know. Oh, Carrie Underwood.
Yeah, that's her.
Oh, she's playing tonight. Okay. All right. Let's look at this QQQ. The NASDAQ 100
is here.
Yeah, she is here. Let's look at the NASDAQ 100 here. So 13% rally since that kind of 4-month low. It made a 4-month low late last month. So it was October 26th. Double top. That's what it looks like to you.
Yeah. And it's, again, maybe I'm clutching at straws. I don't think so. But this coincides, obviously, with the move in NVIDIA from 400-ish to basically 500 over the course of the same period of time, which is remarkable.
Yeah.
They report, I believe, next week.
The November 21st.
Which is next week.
Well, let's pull up the NVIDIA chart.
Now, what's going to happen here in terms of NVIDIA is either going to crush it and give another, ridiculous revenue guide that nobody's anticipating because a lot is in this stock now, or they're going to say something that the street's not going to like. I don't know what it's going to be. Maybe margins start to deteriorate a little bit. I don't know. But if you see listen, over the course since last quarter, you saw the stock go from 500 to 410, back to 470, back below 400 to levels we're seeing now. That's over the course of last earnings period to this earnings period. So the volatility is there in the stock. As much as people think it's a straight line higher, it's not. And a lot rests on what they say next week. Now, the bears, myself included, are putting a lot of stock into that, maybe incorrectly. But the move that we've seen in the NASDAQ over the last week and a half is unnatural in a word.
Well, the QQQ, okay, got back to that prior high. You got that rising 200-day moving average, which is kind of just came off.
We stopped dead at it.
Just, last Monday, so I put a QQQ trade on. We did a little market call break in. The QQQ was 369, and I was looking at the 365, 340 put spread. It cost like 1% of the ETF price. This was in December expiration. So that obviously has gotten blown out. And just to be really clear, we talk talk about these long premium directional trades, whether they be in stocks or ETFs, you got to use stops on those people, like at least a mental stop where 50% of the premium, if you get wiped out, you don't want to see those go to zero. I will take another crack at this. Maybe that double top is the thing. Let's see how the NASDAQ, let's see how we close today. Let's go back to the NVIDIA chart today, because this one's interesting. The stock is down 2.3%, guy. It got to a new 52-week and all-time high. It got right back to that period of time that you're talking about from August. And look at the steepness of that rally. And, we talked about it yesterday in the market call. That was like $250 billion in market cap. So we're going to spend a lot more time talking about NVIDIA next week. But the QQQ, I'm getting ready to get back in there. I think some of those stocks look
a bit keep swinging the bat. As painful as it is, you got it. And the great thing about what you've been doing is, you get nicked, you get nicked, and then you catch it. As long as you're disciplined, you don't have to be right 50% of the time. As a matter of fact, Mark Fisher, who in my world, my commodity world, is a legend in the oil trading ring. And he'll tell you flat out, I've heard him speak, he's right 25% of the time, maybe he'll tell you, yet he's able to do well because for those reasons exactly. You get nicked, you're wrong. Then you catch something, and then it's when you start to layer. And it's like being at a craps table, Danny Moses. You're going to 7 out. Then some Johnson out of nowhere goes on some 35, 40-minute roll, and that's when you lever things up. And it's the same thing in the stock market.
Yeah.
You like that?
Let's talk.
By the way, it's Dan. I'm sorry to do this, but Danny's here, and he's listening to this. They've just made craps legal, apparently, in the state of Florida. That doesn't help us on this trip.
Nope.
But we'll be back here in January, not here in Naples. We'll be in South Beach. And during that trip, Danny Moses and I have decided we were going to go find a craps table.
Nice.
And spend a few hours. Anyway, back to you.
Really quickly.
If the folks want to meet us there, I don't know where we're going to be. Do you have enough time to figure it out?
Yeah.
Back to you.
Amanda, you had a tweet. It was something highlighting some laggards in the market. And folks, maybe it was on the Twitter, just suggesting that, you want to kind of, if this market is going to broaden out, you want to go for some laggards, that sort of thing. And you kind of posed a question. A couple names I've kind of been looking at over the last couple of weeks. One was PayPal. Just look at this, we know the stock's down 80% from its all-time highs in 2021. This thing, even in that quarter that they reported about a month ago, wasn't that bad. The stock still sold off.
It's amazing to me that given the stock, and if we have a longer-term chart in PayPal, just to show how dramatic. I mean, this goes back to a couple of years ago when the stock was starting to decline. Yep. And then there was news that I think they were gonna purchase Pinterest, but they said, you know what, they ain't gonna happen. But the market got scared because it said, wait a second, even if they're thinking about doing something, they're trying to buy growth, that's not a good sign. The stock continued to decline, and you have no bounce in the stock now for quite some time. Yet, as you said, here's one that valuation's actually okay, and they seem to have, in my opinion, the last quarter was a turning of the corner. But nobody cares. The market would rather be in high valuation, high multiple, growth stocks that seemingly never they go down, but they don't go down for long. Yeah, and that's a little fugazi to me.
Yeah, I mean, the story has just been like the pull forward that they had during the pandemic. This was a company that was doing mid-50s like gross margins. They went up dramatically when digital payments or peer-to-peer was like popping off and everything like that. Now they've come in pretty dramatically, trading at about 10.5 times next year's expected earnings growth of about the same percent. Sales growth, high single digits or so. Some new management changes today. If you just want to look at the 1 year chart that I pulled up, and you can see the downtrend. It's pretty simple. You see where that 200-day moving average is. It's up, up there, $67 or something like that. So if we're going to continue, if the NASDAQ's going to go back towards those, through those prior highs, you'll see stuff broaden out. Another one that works on valuation too, also a beneficiary of the pandemic. This would be Zoom. This is also a very profitable company, trades at very cheap relative to its expected growth and the like here. Look at this thing. I mean, like, could that thing get back towards, $75 like that? You know what I mean? So I just wanted to kind of highlight a couple names that were on my radar. All right, guy, we talked about Target earlier. Let's talk about Walmart. Okay. So this one, I think is going to be important for the retail sector in general, because while a lot of the department stores, a lot of the dollar stores, a lot of some of the weaker, like kind of apparel retailers that have not been doing well over the course of this year, Walmart seems to be eating everybody's lunch. Okay. The implied move in the options market is about 3.5% in either direction. You look at the chart there, you see it's on just a runaway breakout here. into the print, when you think about it, that chart just tells you that expectations are high and sentiment is very bullish. The stock's valuation relative to many of its peers, relative to the market, is very rich. And I just want to make one point. You could put this in the camp not too dissimilar than consumer staples in a way, right? It's very defensive. They've been benefiting from the trade down, that sort of thing. How do you think the setup is into the print? Because I just, to me, it seems like the kind of the thing that they have to jump over is getting higher and higher by the minute.
The answer to that question is not great.
Yeah.
You know, it's just not great, especially now off what we've just heard from Target. Now the expectations have obviously been ratcheted up considerably. And my sense is they're going to have to do something on the margin side of the equation that are going to surprise people, the upside. And I'm not sure how that can happen. So again, this was a name that Danny talked about a couple of years ago. Walmart, he liked it. He was correct. I want to be clear. I still think that Walmart-Target relationship can continue. Today's obviously throwing a little bit of a monkey wrench into that. But I'm inclined to say, you know, you take some money off the table into Walmart, and if I'm wrong, I'll come back tomorrow and say it, and you look for a better entry point, because the expectations, I think, have been ratcheted up considerably given what we've heard over the last 24 to 48 hours.
So it's interesting. The stock, we said the implied move is 3.5%. So if you were going to pick a direction in the weeklies, and again, you know, like you really only need less than 2% either direction. But like the likelihood that this stock can rally the way a Target, or decline the way a Target, which has a much smaller market cap, doesn't make a lot of sense. So with the stock at 169 right now, the 170 put on this Friday expiration is offered at like 330. That's like 2%. Okay. So it's $1 in the money. So if you were long this stock, that could be kind of a cheap hedge. Or if you just wanted to make an outright bearish bet, that looks kind of interesting to me. I wouldn't buy this with your money, Guy, heading into the print.
See, that's a put spread that could be interesting. Yeah. And again, I don't want to, but maybe it's the
170, 160 or something like that.
The 168s, 160s, but I'm just doing it off the top of my head, because I think you wouldn't mind being put into the stock at a level. If you get paid enough,
like a 1x2 or something like that. But again, like listen, you can sell puts, but like the point is the move is priced fairly cheap in my opinion. So I don't know if you're getting paid to sell puts into the print.
Do we have a TJX chart real quick?
Yeah,
because this is one, if you look, you know, I don't want to make a big deal out of this either, but we traded up to levels that we saw back in early September. The stock TJX is off now today on the day. Again, they needed, we talked about this on Fast Money the other night, you know, they needed to say some really good things in order for this move to continue. And it's obviously not happening today. It's not an indictment on the company by any stretch of the imagination. It's had a heroic run. But, you know, you look, we were traded up there in September, traded all the way back down, made this sort of stair step to the back to these levels, and seemingly failed. You got to pick a level here to get back in, but this is not it, in my opinion.
Yeah, no, it's interesting that we're talking about that, not just retail earnings. There's a bunch of other earnings here. Cisco reports also tonight after the close, 4.5% implied move. And, you know, this one is actually, it was interesting. I think we spent some time in the summer talking about, you know, Dell, Oracle, you know, Cisco, even Hewlett, so IBM, some of these like old, you know, like kind of darlings of the late 90s, early 2000s, you know, having their day. And this stock had come in pretty hard off of their like kind of August highs, and had a disappointing guide back in August. And the stock's banging around here, you know, pretty decent on valuation. I'm more interested to hear what they have to say about certain regions and demand and the like here. And, you know, they're probably going to talk about software. They're going to talk about cybersecurity. They're going to talk about how they're implementing AI for a lot of these sorts of things. So I don't really have anything like a trade one way or another. But before we get out of here, I want to hit Palo Alto, Guy. Okay, so this one, I know this has been a stock that you have for years. It seems like every time the stock moves lower, you have been positive on it for the secular shifts that we're seeing and the like here. And, you know, there was a time where it felt like it was a lot more expensive. You know what I mean? This was like when the earnings power hadn't really kicked in or so. But this is a company expected to grow earnings 20% a year for the next few years. And when you think about that on, you know, expected you know, revenue growth of not too different, or different, you know, margins improving to about 76%, expected revenue growth in the high teens. So this year trading about, I know this sounds obscene, 47 times and 10 times sales, but it's next year 40 on 8 times.
But it's more, you can reconcile that a lot easier now than you could a couple of years ago. And one of the arguments that we made I think correctly, was it's an expensive stock, but it's the best company in a secular shift that's been going on, and you have to sort of stay with it. It was painful at times. That you saw some dramatic moves to the downside because, if they came in line or slightly missed, the market punished them, and I understand that. But to me, this is sort of, and we'll talk about this maybe at a different show, but what's going on in uranium, there's a secular fundamental shift going on, and valuations are stretched, but this is going to be around for a while. The same way that cybersecurity, when we started talking about it in earnest with like Zscaler and some of these other names in Palo Alto, you could see what was going on, but you knew there were going to be times where it was going to be really painful to own the names. Now, with that said, it is still expensive, not as expensive as it was with the expected growth rate. But I will say this again. I think you have to just sort of stay long PANW and understand that they're going to be good days and bad days, but they'll be more good than bad.
Yeah, it's pretty astounding, though, because we just talked about these two companies that are reporting, Cisco and Palo Alto, and they do compete on a couple different product areas. So we just said that they're expected to have $8 billion in sales this year, trades 10 times those sales. It's a 76% gross margin. I just want to put that in context versus Cisco's market cap of $215 billion. Okay, so 80 versus 215. 10 times sales for Palo Alto, and Cisco obviously trades at a much lower multiple, but it's got expected to have, let's say, $58 billion in sales, and you just look at the margin profile and the like. That's one of the reasons why Cisco's been moving towards recurring revenue models in the software space or whatever, and they have 65% gross margin. So that's how we kind of think about some of these things on a comparative basis.
You have recurring, when you have visibility like Cisco has, the same way IBM had it 10, 15 years ago, you're going to be rewarded in terms of the value. The market will pay a higher multiple for that visibility, which, Cisco probably doesn't get the valuation it deserves, quite frankly. So we'll see.
Yeah. All right. Well, I just wanted to make that comparative. And again, so to me, the Palo Alto, though, guy, beat and raise, stock breaks out of that range, but any sort of disappointment on margins, on, and one of their competitors, Fortinet, had a very disappointing quarter a couple weeks ago, I think. It had a big gap lower, very near its 52-week lows, and it was, at 52-week highs just a few months ago. So again, just being cognizant of that. And with an 8% implied move in either direction, just to make a daily sort of move, like a directional bet, you're risking 4% of the stock price. That doesn't look like a great risk reward to me, unless you have really good conviction. All right, we covered a lot of ground here.
We did. We're still in Naples, Florida. Rain.
We're still here.
Apparently, it hadn't rained here in quite some time.
Yeah,
and the one day we needed to be nice was not nice. It was unfortunate. But we're going to get Danny out of his funk. Amanda's still here. Jacob is still here. Timmy and Steven back at HQ
in New York. We're gonna go back there tomorrow.
I want some comments on this shirt, in case anybody cares.
Jacob's gonna do a little close up on the shirt. It's pretty cool.
It's got like banjos and boots.
It's got guitars, boots.
I call it a banjo.
Something else in there. All right. Well, that's it. We're gonna be back tomorrow. I think slightly different time because you and I are gonna be heading back to New York.
Yeah. What time tomorrow are we doing?
Probably 2:00. So stick around.
Well, we'll let you know. But
Carter Worth on there. Carter Worth will be with us.
And we got a great podcast dropping on Friday.
Yeah, we do.
Danny, me had a great conversation with Terry Duffy, and that is always newsworthy.
Yes.
Or news making.
Yes, it will be. All right. Stick around.
Stick around.
All right.
Catch you folks later.
Thanks a lot.